I'm Janelle Selden-Holtmeyer, Associate Editor of Modern Distribution Management, and today I'm talking with Yingying Xu, an economist with the Manufacturers Alliance, MAPI, who specializes in the Chinese economy. Good morning, Yingying. How are you today?
Good. How are you?
I'm doing well. So, it's common nowadays for conversations about the U.S. economy to turn to China. Could you talk just a little bit about the economic relationship between the U.S. and China?
Sure. The economic dependence between these two countries have increased over the past decade, and the connections are mainly come from two channels. One is trade and the other is finance. From trade perspective, during the past decade, U.S. exports going to China actually rose 5 times. So China has become U.S. third largest export market behind Canada and Mexico, but it still accounts for less than 5% of the U.S. total exports, while U.S. markets account for about 18% of China's total exports. Imports from China have climbed to 19% of total U.S. imports, while imports from the U.S. account for about 7% of China's total imports in 2010. But these numbers probably underestimate the true importance of China's dependence on the U.S. export market. U.S. imports still account for a significant share of the world's final consumption demand. Therefore, a slowdown in U.S. demand could lead to slow growth in other economies that actually export large quantities to the U.S. and therefore have indirect negative impacts on Chinese export growth to those economies as well. But the imbalanced trade flows between these two countries have complicated the relationship. It's widely known that the U.S. currently runs huge trade deficit with China, and the revaluation of China's currency has become one of the focus of the tension. In 2010, U.S. trade deficit with China reached more than $270 billion. So this accounts for more than 40% of U.S. overall trade deficit. Meanwhile, in China, it has accumulated $2.8 trillion foreign exchange reserve over the past decades, and about 70% of the increase actually comes from trade surplus. Here's a little background of China's exchange regime. China reformed its exchange in 2005, and since then, the renminbi actually appreciated about 20% against the dollar in both nominal and real terms. By 2008, appreciation pace was interrupted by the financial crisis that resumed again last August. So during the past year, the renminbi appreciated about 6% against the dollar. But since dollar depreciated against most currencies, so the real effective exchange rate of renminbi actually went down a little bit. But in general, it's pretty difficult to estimate the equilibrium value of the renminbi, but it is widely acknowledged that the renminbi would appreciate significantly if the authorities stopped intervening in the foreign exchange market. This is a trade channel. From finance perspective, despite the notion that U.S. firms investing heavily in China, official FDI flows from U.S. to China peaked at about $5.4 billion in 2002 and have remained at less than $4 billion since 2005, which is less than 5% of total FDI in China. This number could be underestimated due to American companies' use of offshore financial centers to channel FDI flows in order to gain some tax benefits. But all available data indicated that most FDI flows to China are from other Asian countries that are integrating their supply chains with China. The major financial link between these two countries remains to be China's purchase of dollar-denominated financial assets. And China doesn't make public the composition of its foreign exchange reserves, but estimates based on U.S. data suggest that Chinese holdings of U.S. Treasury securities reached to about $1.1 trillion at the end of 2010. This is more than a quarter of all U.S. debt held by foreigners and about 11% of total outstanding government debt held by the public. So China accounts for a considerable proportion of U.S. debt financing. Despite the recent downgrading of U.S. credit rating, China continued to hold huge amounts of U.S. debt and even bought more U.S. debt assets for the past 2 months. One major reason is that when the entire global market is in the middle of a financial crisis, investors are concerned more about the safety of their holdings. So far, U.S. dollar is still the world's strongest currency if we think from the angle of national strength, including the elements of the education, science and technology, political system, as well as extent of a currency internationalization. Only if China continues to run current account surplus, it will have little alternative to buying U.S. Treasuries with the reserves it accumulates while managing its exchange rate. It means at the same time, U.S. will continue to need willing buyers for the debt issue to finance its budget deficit as well. So this is really a mutual dependence relationship, and there's no reason to expect this pattern to change in the near future.
Another conversation that comes up about China is their growing manufacturing base. What's the outlook for manufacturing in China?
During the past decade, China has become the global manufacturing powerhouse. So in 2008, the output of China's manufacturing sector reached about $1.4 trillion compared to the $1.8 trillion manufacturing output in the U.S., while China is expected to overtake the U.S. to become the world's largest manufacturing nation in several years. During the most recent global recession, even though many countries around the world saw their manufacturing output shrink considerably, China was able to ride out the recession. In fact, the value added for manufacturing sector continued to register double-digit growth for the past 2 years. But the global downturn does help to develop some new trends in China's manufacturing sector. One is a migration of manufacturing companies from southeast coast to inland areas. Until recently, the southeast coast of China has been the central hub location for many multinational companies because of their reliable infrastructure, close proximity to deep-sea ports for global exports, and the availability of high-skilled and low-cost labor. But in 2010, the labor shortage in coastal areas became severe and persistent, and there were a series of reports about labor strikes demanding higher pay and a better working environment. So wage actually increased by an average of 17% in 1 year. These higher labor costs are starting to force manufacturers to think about setting up new plants in the inland region of China, where labor costs are 20 to 40% lower than East Coast towns and cities. This is actually in line with the government's plan, since the spread of companies across the central and western regions of China will help to develop China's domestic market and hence reduce overall reliance on exports. The other new trend is Chinese manufacturers' increasing willingness for global expansion. The main trend over the past decade has been for Western manufacturer companies to establish joint venture operations in China. This arrangement has worked well over the years and has allowed Western companies to get a foothold into a very lucrative market, while it allowed Chinese companies to acquire valuable management knowledge. But during the recession, some Chinese manufacturers are actually started to build brand new plants in foreign countries. One good example will be the telecom device manufacturer Huawei. They are actually setting up new plants in Eastern Europe. Other Chinese manufacturers are acquiring entire Western manufacturing operations. This is more obvious in the automobile sector. Traditionally, Chinese manufacturers favored the machinery and textile sectors, but recently, the investments in our FDI in agriculture, mining, and energy have surged. The high-tech and clean energy technology companies are becoming hot targets as well. This has been part of China's efforts to upgrade its manufacturing sector and moving up the global value chain. In fact, this has become a major component of China's new 12th five-year plan. This plan pinpoints 7 strategic emerging industries as key areas of growth. So this includes high-end equipment, biotechnology, new generation information technology, advanced materials, alternative fuel vehicles, and energy conservation and environmental protection. So governments at all levels are expected to use all types of policies to facilitate the development of these strategic emerging industries. There are reports that they are prepared to partner with the private sector to spend approximately $2.2 trillion over the next 5 years. The goal is to increase the contribution of these strategic emerging industries from the current share of 5% of GDP to 8% by 2015 and 15% by 2020. Because of the huge regional economic disparities, the 5-year plan also fine-tunes the industrial policies of different regions within China. The coastal regions will participate in various pilot projects for the advanced manufacturing industries and the formation of indigenous R&D centers. The inland regions will maintain their investment promotion policies. The northeastern provinces will work toward the development of heavy industry and modern agriculture. Central China will focus on manufacturing and creating logistic hubs, and the western region will concentrate on natural resources and transportation. But the effective implementation of the 5-year plan will have lots of challenges, and it is unlikely that the various objectives of the plan's ambitious agenda can be achieved with equal success. One challenge will be that certain expected goals are not mandatory and therefore don't carry as much weight as the binding goals, which have become key performance indicators for local officials' career progression. The other major challenge is the opposition from political powerful vested interest groups that actually benefit from the current system. They will for sure to make it hard to push through necessary but painful changes. Of course, there are some short-term challenges as well, which include inflation and the massive leadership change expected in 2012. But what has already become evident is that during the next 5 years, China will experience significant changes in its economic and business environment. So this will present both opportunities and challenges for foreign companies doing business within China.
Is there anything else that you'd like to add about what's going on with the Chinese economy or how China is interacting with the global economy right now?
Right now, in June and in July, there's some very obvious signs that Chinese manufacturing industry actually slowed down significantly from the first half of the year. The major reason behind this slowdown is the tightening of monetary and fiscal policies. Right now, inflation is still a major challenge and still has priority over growth. So the interest rate keeps high, and it's pretty difficult for small and medium-sized manufacturing companies to get credit and get loans. At the same time, the transformation and upgrading have pushed some small and medium manufacturing firms into crisis. The other negative impact for the production is a rise in raw material prices and labor costs. This has squeezed the manufacturer profit margins. The other thing that hasn't got much attention is that many manufacturers have invested in real estate sector hoping to turn a quick back, but because of the housing market in China has been sluggish due to tightened government regulations, these efforts have dragged manufacturers further into trouble. Meipai's forecast for this year and next year is for manufacturing production to slow down for the second half and also very likely in 2012.
Well, thank you so much for your time today.
Thank you.